Hi friends, today we'll discuss about the topic government budgeting. This is also in the GS3 syllabus. Okay, government budgeting is reflected as part of the presentation of the budget by the government of India. This is generally done in the month of February. Okay, let's understand what budget is. Budget is the annual statement of receipts and expenditure, or annual statement of expected receipts and expenditure for the coming financial year. Suppose budget is presented in February, it means it is for the next financial year starting from April and ending in March. So in our constitution, budget is dealt in Article 112, and in this it is called not as budget but as annual financial statement. So budget is an annual statement of expected receipts and expenditure of the government of India for the coming financial year. But in the budget document, not only there will be expected receipts and expenditure, but also there will be the actual receipts and expenditure for the present financial year. This will also be there in the budget. Now let's come to the importance of budget. Government is presenting the budget, so we should understand why it is important. Firstly, government budget allocates resources for administration of the country. So we have many ministries which are involved in the governance of the country. So government allocates money for administration. Second, government through its policies promotes economic growth. Suppose government has come up with a policy called Make in India, and to make it a success, government allocates resources, allocates money and other resources. So this promotes economic growth, and this allocation of money is done through budget only, because not even a single rupee can be spent without the approval of the parliament, and parliament approval is taken as part of budget. Also, government can create more infrastructure by allocating money, means assets can be generated. Up to 2 years back, we had a planned economy. There, as part of plan, huge capital assets were being generated, and the money for generation of all these capital assets are provided through the budget. Next, government also through taxation helps in reducing economic disparities. It means the rich are taxed, and through government welfare policies like MG Narega, livelihood missions and all, the taxed amount or the revenue is distributed. This reduces economic disparities in the country. Government also through budget can provide for employment opportunities. Budget is also a document which reflects the policies and objectives of the government. So now government has a policy of skill skill India. So as part of that, more employment opportunities can be generated. So budget is also helps in generation of employment. Budget is also used to bring stability in prices because it depends on the government's borrowing. Suppose government borrows more and more money, it leads to increase in money supply. Or if government borrows money from RBI, it leads to increase in money supply in the economy. So that will increase the prices of commodities. Also, if government spends more, then there will be more money chasing few goods. So that will also invariably lead to increase in the prices of commodities. And finally, government's budget will also have a influence on the balance of payments situation. Suppose if government does more external borrowing to finance the deficit, that will uh, have a harsh impact on the balance of payments scenario. The balance of payments means imports minus exports. So in India, we have more imports and less exports. So our balance of payments situation will always be on the negative. Now coming to what are the major components of government budget? Normally, Indian budget is divided into receipt side and expenditure side. Receipts are the current income. Receipts are the current income of the government or money which government got. Money which government got either through borrowings or through sale of shares or through recoveries of loans. So receipts. Expenditure is what government spends. What government spends. So receipts and expenditure are divided into two types: revenue receipts, capital receipts. Revenue expenditure, capital expenditure. So now let's talk about revenue receipts. Revenue receipts are the current income receipts. Means this is the current income of government, and revenue receipts do not place any future obligation on the government. So revenue receipts can be divided into two types: tax revenue, non-tax revenue. Means revenue from taxation and revenue from other sources other than taxation. Tax revenue can be divided into direct tax revenue, indirect tax revenue. Direct tax revenues are income tax, corporation tax, wealth tax, etc., gift tax, etc. Here the burden of tax is directly borne by who is paying the tax. In indirect tax, the burden of the tax is not borne by the one who is paying the tax. Suppose indirect taxes are uh, like excise, customs, service tax, sales tax, etc. So excise tax is levied on manufacturing of goods. So the manufacturer has to pay the tax, but as part of selling his goods, he will transfer the burden of the tax onto the customer. Same is with these other indirect taxes also. Coming to non-tax revenue, we have three types. One, interest. Suppose government would have given loans to some industries or to some state governments or local bodies. So government will earn interest on those loans. That is one of the types of revenue. Second, government has many public sector undertakings where it is a major shareholder or only shareholder. So there the PSUs will earn dividends and profits. That is also a revenue for the government. And government may also get external assistance. This will be in the form of gift or low donations, etc. So in this revenue also, government is under no obligation to pay it back. So the external assistance is also in the form of donations or gifts. Now coming to capital receipts. Here government is receiving money, but it is either leading to future obligation to pay it back, or it is reducing the assets of government. So let's take this example, recoveries of loans. Suppose government has given loan to someone. If it gets interest from that loan, it does not lead to reduction in the asset of government. But when the whole loan itself is recovered, it leads to reduction of asset. Okay. Second, here other receipts means like sale of shares. Suppose government has a public sector undertaking. If it gets dividend or profit in that, does not lead to any reduction in its asset. But if it sells its shares, then it leads to reduction of the asset of the government. Coming to borrowings and other liabilities. So these borrowings and other liabilities can be domestic or external. Domestic may be from public through like Kisan Vikas Patra, etc., or to from banks, etc. External means from governments, from these external funds, etc. So, but these borrowings create a future obligation on the government to pay it back. So, when we see receipts, revenue receipts are the productive ones. Means government is under no obligation to pay them back. But in capital receipts, we have an obligation to pay it back. Now coming to the expenditure side, there are two types: revenue expenditure, capital expenditure. Both revenue and capital expenditure are divided into plan expenditure and non-plan expenditure. Revenue expenditure, it does not create any asset. It is for routine functions like payment of salaries, maintenance of property, etc. Capital expenditure leads to creation of asset. Capital expenditure leads to creation of assets. When this expenditure is distributed among plan activities and non-plan, then they are called non-plan revenue expenditure, non-plan revenue expenditure, plan capital expenditure, non